Hello.
Hey there, Robert. Sorry for the little delay here in getting this moving.
No problem.
How are you?
Things are busy. They're a little dark here in Halifax. We're an hour ahead of you.
Already, yeah, I know it's been tough to get the dog walked and such, but this too shall pass. All right, so
Fantastic.
you can't see me yet. Let's fix that.
Are we live?
We are
Fantastic.
live now. Hey there, everybody. Happy
Wow.
Tuesday.
Love your picture.
Oh, yeah, these three. They're the reason for the season.
Love it.
Let's see. I've got a new share. Oh, that's what I'm doing. So macro to micro power hour. You gotta see the scene here, which is what we do on Tuesdays and Thursdays, and very gladly, very luckily, I have Robert coming in to give a little bit of his oil views, not a little bit, but in-depth oil views. And I appreciate you coming in on this Thursday afternoon after the close. And well, Robert, where would you like to start?
Great day today. You have me as roughneck.
Oh, this is too funny.
And 3 weeks ago, I was old oil guy. So
I was old. Yes, got to mix it up a little bit.
I wonder what I'm going to be next time. Yeah, big day in the market today for sure. I thought we could start maybe. Can you pull the chart up, the CL or whatever, and we just talk about it a little bit?
I'm running into my computer actually kind of late. How about you pull up yours? I've made you panelist, and I'm going to fix my camera right now because I have a zoom on it, and I really don't want you, looking at my pores. So you bring up yours, and I'll come right on back for. Can you? You can
find mine. Bear with me for a second then. There we go.
There we go. Let's get that going on.
We're both scrambling here today, so apologize to everybody. You see that?
We got good things to share, so it's worth sticking around.
How's that look? You see it?
I can.
There, perfect. So this is an old concept I learned many, many years ago from a great commodity broker named Don Morton from
Okay,
from
speak
Boston.
up a little bit, because maybe I'm not the only one that can't. I'm having a hard time hearing you. Let's do this.
I'm hearing you perfect. How's that? Much
better.
Okay, cool. So part of my process is I just line up crude, fuel SD and gasoline, just kind of look at it daily. Below there's same instrument, just 30-minute, give me a little perspective, although I'm not a day trader, as you know. And seeing, kind of follow along. Really neat thing here is, heating oil's been, ULSD's been the strongest component of the complex now for a few weeks. I call it the toilet paper rally. Same thing happened back in the spring when we were in the midst of the lockdown, that it outperformed the other two legs of NYMEX. And you can see here, gasoline's really been the laggard the whole way along, although we got in and filled this gap here from August today, which was big. And you and I talked about this earlier this week, or last week, this flagging here that happened. So that wasn't perfect. We had a little bit of a pullback off them, but that ended up being a pretty good setup for a move higher or whatever. So, we had this breakout here of some longer term ranges, and I'll get back to that in a second. And look at this beautiful return move. How do you like that?
I like it very much. We literally talked the same day that this decided to, hot fire flames take off higher. And we did this talk, I think, 2 weeks ago.
Yeah.
With that same premise. So it was.
Yeah, that number was 43.78, which we'll talk about it in a second, which is a huge number. So I just want to blow up the crude here for a second. We talked about the last time I was on. I really like ranges from a technical part. I know, you're the chart expert. I spent a lot of time early in my career on charts, like everything very detailed, and sort of more of a technician early. But I found over the years, in terms of my trading, is that ranges are very effective in the petroleum complex. So you can see here, really, since when demand sort of plateaued out in June, we've been in this long trading range here. Couple of them, there was an inner one which was called 37 to 41.5, and then with this little washout here was 33 to call it 43.78. So there's been a pretty decisive break here, return move, and so standard is measured move implications, sort of $7-10. So I'm thinking 52, 53-ish or something is a decent number, in terms of an objective of this breakout. So, most of my stuff has been sort of weak lately, and price, which you always respect, is something that moved this week. And so we need to give that some respect. So that's just a general price. We've sort of broken out here, and we're going to move higher. And gasoline sort of got with the party today, which is the positive. A lot of the data is kind of weak, so we're kind of running ahead of ourselves. I'd like to call it right now. You and I are having some fun with this. I got a chart to show later. I call it jump the shark. So the market's really running ahead of itself here. We have this near-term demand weakness that's driven by the mobility restrictions on the second COVID wave. We're trying to get to what I call the vaccine rainbow. What it's going to be like after we recover from all the lockdowns and whatnot. I thought
isn't that what they're pricing in right now, the vaccine rainbow?
For sure. Yeah, we're well ahead of ourselves, and we'll talk about that in a bit later. XLE's well ahead of itself. It's got a couple of large integrateds in there, so we're running ahead here. Obviously, we'll go through some of the fundamental data, which is quite weak near term. So yeah, for sure, the market's trying to jump the shark here to the vaccine rainbow. Saxo Bank had a great graphic, which I sent you today, which was tied in with their 2021 outrageous predictions, which is a great piece that they put together every year. And they had behind a guy carrying a syringe, all the nasty stuff, and then a friend was all this dollars and flowers and bright lights. So, I think that was a good graphic for what we're dealing with here. So there's no question we're kind of moving. Largely for us, for me, the kind of move's already over. Like we were in early on this, and particularly with Exxon. So we're kind of in the watching kind of mode right there now.
Yeah,
I'll just
I don't
sort of
know
stop
if
that share, but I think, and there's great debate about that, which is great, So for us, we watch most of the year. I've told you before, and I'm probably over trading versus historical for me here. Maybe 3 or 4 good trades a year that I've developed, or that you don't know what they're going to be, but in the oil market every year. So we spend most of our time more watching or whatever. I mentioned to you last time that I've developed a model. It's about 10 years old. We call it the Energy Price Index. So it has 17 indicators that we measure. Money flows, technicals, a bunch of fundamental data, crack spreads, weather, geopolitics, macro, seasonality, and at the depths of the low in March, it was actually March 23rd. I was looking at that last night to talk about today. It registered 25, which is the lowest reading it ever had in the 10 years since we developed the model. And right there now, it's about 62. To give you a perspective on the highs off the Soleimani killing in January, was kind of 65. So for us, it acts as kind of a stochastic. It's not a trade signal, but it just kind of tells us that things are probably stretched one way or the other. So
where is this signal?
It's not really a signal. It's just kind of a measure of, we call it, you use a different take on it, word it differently. We just say, is it safe, So then what I tend to look for then is just either regular trade setups to kind of go the other way, or we talked last time. Really, I've been focused on the last couple of years is build up in sentiment or narratives, and we'll talk a little bit about that later. So, you get extreme sentiment, narratives build up, your models are pointing the other way. That's usually good indication to start thinking about going the other way and looking for how that might manifest itself. And then, you would enter trades just much similar as you do, whether it be technicals or see something, money flows. I think that's where you and I link up, right? A lot is, we talked last time, it's uncanny when we do talk that when I share an idea with you, we have the same idea, but we're coming at it from completely different process. And I think the intersection of that a lot is all the work that you're doing on flows and stuff like that. Would you agree?
Well, some of it's macro. I mean, I had written a piece back in July, and you and I have been talking obviously since about the whole, oil went negative and then bounced strongly, plateaued for a while, and then where would it go from there?
Right.
But the oil shock yet to come, the geopolitical risk that you said premium was very cheap relatively speaking, right? So I kept that in the back of my mind, but also this idea that back in, the May collapse, if you will, market had already bought into the idea that we reached peak oil demand regarding COVID. Now they're pricing in the vaccine rainbow,
Right.
Almost in spite of what OPEC is doing. I mean, this is kind of interesting how your models lined up longer, my models lined up longer. And then we had the whole Biden bid, and, pre-election, we had the growth to value rotation. We had the vaccine candidate, if you will, Pfizer and BNTX announce on November 9th. But it was already, the tailwinds were already there, and they were starting very slowly. Your chart for open interest, and not the kind of open interest we use in the option world, but open interest as it relates to big money coming in and looking at your stranded asset theme, that was starting to come in the futures market. So the commitment of traders. So this to me was a little macro, a little bit of your interpretation of your indicators, which are spot on. And then of course, all the kind of intermarket stuff that was still signaling it's almost as if it's going to fall again, it would have by now. It's stabilizing, they're coming in, they're absorbing that supply of sellers. And anytime there's a narrative like we've reached peak oil demand, take the other side.
Yeah. So do you agree with my vaccine rainbow thesis? What do you think?
Explain a little bit for those who might just come in.
Yeah, so I think basically, I've been hearing a lot in the last few weeks, which is really interesting for some people I really respect. But, there's a lot of people thinking like next summer, we're just going to have this demand explosion, like once everybody gets out of jail, they get their vaccine, they've been cooped up now for 9, 10, 12 months, a year. Like we're just going to go nuts, and energy is about mobility and we're all going to move around. And actually, I think it's going to become somewhat of a self-fulfilling prophecy. But then I think when it's over, it's kind of like, remember when you're a kid and you're, drinking a hard liquor out of a funnel at a party or something, seems like a good idea at the time. And then it's going to be like lunch bake letdown. So if I have to look ahead, and I don't like to forecast, I usually like to trade what's in front of me, but I'd like to think about what could be future narratives and sentiment. And I think there's a lot of sentiment that next summer, this summer, that demand's just going to rock for energy. And it probably can, but I think it'll just be a short-term blip. And then I think we're going to deal with the reality, which is we have a lot of economic damage caused by these shut-ins. We've taken on a tremendous amount of debt, equities that are all-time highs. What possibly could go wrong? And so I want to use my model. I'm going to track it. I'm going to watch. I'm going to measure. And I think that could be a nice narrative to trade off of whenever it happens, And,
absolutely. And
your thoughts on that? I think some of your stuff is like leaning that way. You're skeptical, right?
I'm skeptical, but my stuff still says long. So I mentioned to you, I think was a week ago, you invited me in on your call with your clients, and I said I see the best risk reward right now in the small cap energy players that are going to start percolating or popping up like daisies. Those have been amazing runners, especially this week. So I still see, forgive me, but there's still gas in the can. It's just it looks still going. It's not ready to give up the ghost, and yields still are firm. They're not spiking. We don't have that huge disappointment creeping in yet. Like you said, the lunchtime letdown, which again, explain that euphemism, because not everyone's going to understand that either.
You go to school and you open up your lunch bag and you thought you'd have a certain kind of sandwich and you got peanut butter or something. So
disappointing. Well, we haven't really gotten that yet because the market is still sentiment driven. And speaking of this is one thing I wanted to bring up with you. The mania that's happening right now, not just in the IPO world, the SPACs, but the EV, right? This EV space that has been basing for a while, and now obviously Tesla led the advance this year, up 1,200%, and then NIO and all the charging stations and everything related, peripheral, if you will, plays have been just driven to euphoric extremes with not just the gamma option flow that's been driving price and the dealers having to cover, but also just speculation that oil's done. Like, talk to me about this gasoline combustion is forever going to be dormant. It's EV is going to take over the world. I was reading it takes up, we literally have 0.3% market share of EV vehicles, and they're government subsidized.
Yeah. Well, I don't profess to be an expert on that, but I do believe, obviously carbon's going to be around for decades. And, it's part of the stranded asset strategy, which is, pick the companies that are going to be there at the end to turn the lights out, as we call it. So, I don't try to spend a lot of time. I mean, I think the energy transition is a fabulous trading opportunity for the next 10 or 15 years. I mean, so me, as you know, I'm not a multi-asset trader. I trade one commodity, so I'm not going to break off and try to figure out, how to pick solar companies or electric car makers. I'm trading oil. So I know the impact that the energy transition will probably have on oil along the way. I'll watch who it impacts, and I'll make my theses about who will survive, who the losers will be, what that progression will look like, and I'll trade off of that. So I'm just focused on oil. I'm not going to branch off and try to grab onto that, energy transition rainbow, which is.
I understand that premise, but I'm curious then, when you see something, and why would they change the model? It might be a little busted up, but Exxon isn't necessarily going anywhere. But what about the 4 activist board seats that they announced last week they were trying to go for at the on the Exxon board to get them into ESG? So this sustainability.
That one company last week was a bit of a publicity stunt.
Okay.
I forget how much stock that they owned or represented with CalSTRS. I think it was 0.4% or 1.4%.
Okay, so very small.
So yeah. So and if my view on their position along the energy transition changes, well, then obviously with respect to Exxon or any other company, I'll change my trading tactics. So, and I don't have to own it all the way along. And I'll just come back to the other piece too. I mean, we just opened up by talking about potential upside for crude. I'm not saying it can't go to $65. I'm just saying that I'm largely out of that now. I have some exposure, like I have some long call exposure well above the market, so that if that happens, that'll be a great trade. But just the way I trade and what I'm comfortable doing is I'll just watch here now. But that doesn't mean that the market can't, will, or won't go higher. It looks like it wants to. So.
Well, I'm looking, for me, I approach it a little bit different in that I'm looking technically, right, at these entries. We talked about Exxon above 32.70. I'm like, my God, that's a perfect, low risk entry long. And that was what, 2 months ago? I mean, this is not a new thing that we've been discussing. So when it got there, we were both like, okay, now we got to see how it behaves here.
Sure,
but the other is, for me, the dollar. Now, the dollar has been obviously depressed relative to its peers, and that helps the commodity trade. The copper has just been on an absolute freight train higher, and that whole yield stabilization and rise, again, commodities, they pull the yields higher, vice versa. The whole, China reflation theme, because they got control over COVID early, but in particular, the dollar softness and drop helps commodities. So I look at this going, the dollar might be stabilizing right now, but it's not going to reverse without a trigger short covering, which is very large in that asset. What would cause a short covering of size in the dollar trade? And really, there are 2 things: volatility. And what triggers that? We can talk about those risk factors, but is it safe? If the dollar obviously sharply reverses, the oil trade is going to be put under pressure, period. Right. And when that happens, you kind of, what are the triggers? The biggest one right now that I'm looking at is honestly the dollar yuan. When the Central Bank of China, PBOC, is talking about potentially lowering interest rates again, just like everybody else has been doing globally, right? I mean, the stimulus is nonstop, the COVID relief is nonstop, and the interest rate suppression is nonstop. If they do that, the dollar yuan, that carry trade, reverses, dollar can spike in a New York minute. So I look at that as going, okay, that's an event. And like you said, you've already not only timed the bottom, but you've played all of the meat in the middle. You're not so worried about timing that top reversal, but I'm looking for the dollar as a reversal to say, whoa, reflation trade, careful, commodities are going to come under pressure, no question, currency or volatility coming in, and equities, end of year, something with geopolitical risk, don't know. But until then, my intermarket, as we've discussed, 2 months, 2 weeks, it doesn't really change. It's still doing fine. Exxon's doing great. My Oxy trade we talked about last week,
Fantastic.
Even the small cap energy players just look like they're going in this week, like they just got the memo.
Sure. Yeah. And you know, we all trade differently, as you know, and you're a way more active trader than I do. So just to come back to the macro piece. So, you know, US dollar weak, oil higher, right? So we've been talking, as you know, the market has, because I just follow my model. So you know, DXY went from what, 102 to 94, and oil did nothing, right? Did nothing. Macro traders been talking about the reflation trade in oil all year long, right? Not much has happened since June. Nothing's happened since June. So where I see it is, I don't particularly like those, call it historical correlations, the real macro stuff, because my model will pick it up, and I've got some charts to show you in terms of open interest, speculative money flows, open interest as a percent. So I'll see those traders coming into the market, like much the way you would see it in options flows or something, as opposed to saying, well, geez, the US dollar is really weakening, oil's going to go higher. I'm going to see that, right? And we'll show that it's just a couple of days behind, because CFTC data, as you know, comes out on Friday with the Tuesday marker. Is so far there hasn't been a whole lot of money come into this rally.
Really?
No, and I'll show you. So,
okay, because the option flow has been robust.
Sure, but open interest is barely budged. It's up 2 or 3%. In fact, open interest for crude lost over 40,000 contracts so far this week. Now, I don't know what happened today, because it's a big breakout. We'll know that tomorrow morning.
Maybe they took some chips off before OPEC or something.
Yeah, but at the end of the day, you know, it's like I call open interest and spec interest is the oxygen, right? That fires need to breathe, right? So you need buyers coming in. So I'll see that people that are manifesting that trade, and you know, that's also a trade of, you know, weaker dollar makes oil cheaper in emerging markets and can encourage more use. And you know, we'll see. My model will pick it up two ways. That trade, it'll pick it up. You'll see new players come into the market buying that commodity, and you'll see demand pick up too, right? Maybe not here, but eventually you will as well. So we come at it sort of different, but we'll end up in the same spot, because, you know, look at DXI going from 102 to 94, and oil did nothing. So that kind of, you know, I say, you know, some of these correlations are, you know, 8 times out of 10, they're right 50% of the time, you know what I mean? So, and you have to enter and exit trades. You make a good point about volatility. Now through this pop here, vol's coming down, like way down. So,
oil volatility, you mean?
Yeah, I got a chart on that. So, you know, that's a good place to position. You know, we talked about this trade we had on about a month ago, where we played it both ways, because we thought and still think geopolitical risk is very high. And we think there can, at that time, maybe not so much now, that there could be a demand disappointment. And there was during the middle of October. And also vol ended up showing that it was going to spike. As you know, we saw that little triangle pattern you and I both were working on. And so that was a great short on that tail risk that lower, in terms of just scalping that thing, because it broke through the bottom of the range and then came back up in terms of the flat price. But sort of the vol sort of signal there, they were going to have a little bit of activity. Now,
but now it looks like
disappointingly, it's come back down. So I'd like to reload that leg, which I did, because I still have my higher tail risk geopolitical trade.
What are you reloading? What are you reloading? I missed that.
Just crude oil options, you know, puts and calls, you know.
Okay, so you mean that straddle out in time?
Yeah, exactly. Yeah.
Okay.
$65 call, I think it was a $30 put or whatever. It ended up being a 3-banger on a $5 or $7 move in crude, right? So
a straddle.
All had been cheap, looked like it was going to explode. Didn't know why, but combine that with my thesis that geopolitical risk is high. Is reading, we scale everything out of 10. I still scoring my geopolitical number at 9 out of 10 still now. So that was a kind of a good trade to reload. And the last part you're talking about, so no question, the market just can run like crazy here. I'm engaged for some big upside, and that's about it there. I'm happy with my trade, and I'll sit and watch now. But the progression that you talked about, I think, so flat price rises. So E&P plays, you know, small and large were the first ones to benefit, as well as refiners, right? You saw that with the likes of Valero and the pure merchant refiners.
Marathon still gets a lot of call buying out positioning.
Yeah, because that's a demand recovery. So there's a bunch of stages here, right? That's the demand recovery play, right? Flat price rises, demand recovery, refiners, E&P plays, right? And then, as you know, my theory longer term is that the winning format is, in my view, is integrated refiners, right?
Mm-hmm.
They do a little bit of everything, have different geographic allocations, they have different risk factors, they're playing in different parts. I think that's the longer term. So they benefited along the way, but some of those E&P companies, because crude rises $8-10 a barrel, those companies. But short term, not to get into stranded assets too much, but short term, those E&P plays are still largely consolidation, cost cutting, and to generate better free cash flow, and they benefit from the strip rising. So longer term, and merchant refiners are benefiting right there now because cracks are still low, haven't really responded much to the run in some of these refiners, and we have some charts to show that. We'll quickly get through those. But that cracks will come if your thesis about sharply higher prices and demand recovering, like cracks will eventually come here, right? And then the last piece is integrated, and I think integrated are the survivors. I think integrated are the companies that turn the lights out. So I'm just lazy. I bet integrated because I like integrated. So I used to work for them, and they're safe in my mind.
I was gonna say they're the foundation play. Okay, yeah, I get that. But within refiners, what's your favorite one?
I couldn't really tell you. I mean,
of the big four.
I've always been predisposed to Valero. I think they have an awesome management team. They're the pure merchant refiner. They have good geographic coverage. I was 20 years ago, I used to listen in on their calls and investor calls. I just think they're a good merchant refiner. I don't really follow them or do any work on them, but I've always been predisposed to Valero or whatever.
And on the I have to ask on the E&P, because this is one that I recommended this morning at 15, and it just shot up like boom. APA Apache. I know, not just humor me. What about Apache?
No idea.
Okay,
I'm just a flat price guy. Yeah.
Okay, so then forget that. What about the jump the shark theme? What is this?
So let's just go in that. I got just a few slides.
Because you sent me that graphic, and I was like,
I love it.
I like the fishing theme. You know me and sharks, but what does this mean?
So these are my themes for 21. I've had these same themes for 2 years, which are below there, but I'm running out of D's because I know you're not political, but Donald Trump doesn't look like he's going to get in. I call them socialism, solvency, stranded assets, and stagflation or whatever. So, socialism, it's all tied into these. They just have to change it to S from D. But, deglobalization is here to stay. This great reset's not going to happen. Lynn Oldham ran a great piece recently. Did you read it about the petrodollar and the fact that that's going to be challenged over time because of it requires structural deficits in the States, and the fact that US GDP is such a smaller part of the global economy now. But you talked about one of the outcomes is regional pricing, so things get broken up. They get less efficient. There's more inefficiencies and stuff to trade around. Solvency is always going to be a problem going forward. And then my stranded asset theme, we don't need to spend a lot of time on that, but that's just, people are getting off, they're getting on the EV, they're getting on the ESG train, like companies trying to reinvent themselves, and there's some companies that are going to stay in. Some of them are going to try to stay in, and some of them are going to stay in, and then some of them are best built to stay in. And I just like integrated. So, and then stagflation, this is the theme of that sort of fading the demand recovery, which is, I think people are going to hang around closer to home than a lot of people think. And that's a mobility issue. And I think it's going to be a challenge longer term. So that's a theme, particularly for 2021. So let's just look at, when I say jump the shark, I mean, the market's looking past near-term demand weakness. So this is total demand. This is all products in the States. You can see there we've turned down, like, we're 7.5%, 1.6 million barrels below 2019. This is the same chart for gasoline, so I put the shark on it. So you can see we made a new year over low on the 4-week average here. So, gasoline demand is struggling here, and, we've been locked down in the States. We're certainly locked down here in Canada. Although our data doesn't mean anything in terms of the NYMEX. But demand short term is challenged here. Don't make making a mistake about that. Jet fuel has come back slowly but surely. Like we were down 45-50%. Now we're down 35%. It's still a big chunk of 600,000 barrels a day. It's over 4 million barrels a week of jet fuel that's off the market. And then this is a real chart, I think, that says everything about how good refiners are. I mean, they've shut runs down. I call it run down, you know, so we're running 2.4 million barrels less than we were last year. So refiners on their own, without any government help, have basically balanced the product market. So they've got a lot of, you know, there's not a lot of gasoline and distillate, although there's still a fairly substantial overhang there. They've hunkered this thing down. They're not releasing these runs anytime soon until demand returns. So this is a real important chart to watch. It fits into another theme I have, which is, I call it supplier discipline. So you have OPEC, even after them raising 500,000 barrels a day in January, call it 7.2 million barrels of crude off the market. US refiners, 2.4 million barrels of runs that they're holding back. You know, I hate markets that are rallying on what I call supplier restraint. There's a lot of people that have to be restrained here to create this famous supply demand deficit. So we're not out of the woods, absolutely. And then, you know, look at cracks. I mean, this is as of Friday close, I apologize, but you know, there's a $12 distillate crack. Yesterday it was, I think, 13. We got here, I write everything down, 13 a quarter. And look at all of next year, you know, we're $14 a barrel versus these historical numbers. Gasoline crack's terrible, $7 on Friday. It's up to 8 at the close yesterday. And very poor numbers for all of, so the forward cracks are not pricing in their type of demand recovery that at least the equities are. So, you know, this is why I'm watching more than I'm just jumping on board. And then this is a speculative interest. So I like combining them all in the NYMEX, non-options, because the work I've done before says I don't need to look at that. You look at, I think, more for a trade signal in that. I just look at for net speculative interest. So it's just combining the crude, gasoline, and ULSD spec positions. And you can see we're getting a little frothy here in terms of some of the historical norms. And if I put the pricing on that, these would be, you know, timed fairly appropriately. So, you know, this is less than 700,000. We're at 600,000 here now. So, you know, we're already in a territory where I wouldn't say we're excessive, but we're certainly what I would call elevated, you know.
But at the same time, I mean, I look at that rising 52-week average, and above is bullish, below is bearish.
Yeah, for sure. And that's why the market's, you know, new money's coming in from the bottom here and the prices are moving higher. So, but I'm already in and gone, as they say. And then this is the real important one to me, and it's been a real theme for the complex for the last year. So having a look at the crude price versus open interest, essentially the number of traders. So, you know, we had this huge unwind in crude from 2.7 million contracts down to 2. You know, we popped up on the sell-off, which makes sense, you know, rising open interest, you know, you want open interest following price. And then, you know, we bled off to below 2 million, and we've just been in this range, and we just popped up. This is as of yesterday. It doesn't include today's trading. So, you know, there hasn't been a huge move in the amount of new traders coming into this market, you know, like 100,000 off the lows. So, you know, that, has there been interest from, you know, the lows? Yes. Is this something, you know, that's got me terribly excited? No. If prices are going to continue to move higher, is that interest going to have to move higher? Absolutely. There's only so many shorts that can cover, right? And then I also look at this net spec interest to combine it to open interest. And when you look at that measure, I mean, it doesn't mean prices can't go higher from here, but that looks very elevated to me. So we need more open interest to come in. We need new speculators to come in. So that's not a slam dunk. And then just quickly finish up. So this is OVX that we talked about. This was this little pop here that we traded in November that we talked about. And now we're coming back off, and you know, have a look. Like volatility is come down quite a bit. So you know, that comes off a little bit more, probably establish some tail risk stuff on the downside. I'm not quite sure what that or where that would be, but that's kind of where we're at or whatever. So for me now, I'm just watching. I'm watching. You know, the demand's got to come here eventually once, and I want to see new buyers come in. But for me, given that I don't trade very much, I'm looking. You know, you hit it perfectly at the start. I'm more looking for the top of that range, you know, and seeing what's going to happen. In your world, you probably still got ramp time to do all your stuff in between there, right? So one thing about XLE is that, you know, people, you know, USO got blown up. They moved down the curve to hide from the pandemic. You know, XLE is oil to a lot of people. XLE is not oil, right? XLE's got a couple of major integrateds in there, some refiners. So it's run, in my view, quite ahead. And I've seen all kinds of stuff that says, hey, it's just getting going, it's fine. But when you look at this data, when you look at the cracks, when you look at the demand, and so if the supply demand deficit is coming, great. Like, if this is all going to get cleaned out in the next 3 or 4 weeks or months, great. But for me right there now, I'm looking for the sentiment to build, and for me, my model's got to improve some more. It's already scoring pretty high now, so I'm sort of more cautious here. I've still got some coverage for some upside, but I'm being more passive and watching and seeing how some of these different things have resolved themselves. Right.
So, are you out of Exxon?
No, I just have some calls, some higher strike calls.
Okay.
But largely, yeah, in the last couple of days, I'm out. So.
Wow. Well, that
was good. I mean, we traded the old one, the first pop down. We didn't hardly catch any of it, but I think it was 25%. And then the last, all in with some dividends or whatever, it was like a nice 40% pop. So I've had a year in Exxon, so I'm good. So I don't need to chase this too much.
You don't even want to, not even for the fun of it?
Well, there's a couple of mistakes, but they weren't expensive. I tried to reload at 40, but that turned out to be, that's why I ended up with those higher strike calls, because I thought we were going to go up. So there's that open gap up at 56 there, that big topping formation there. So that's probably a good longer term number. Certainly 46 looks like being sights there now, but.
Oh yeah. So right now it's, for me, I still see higher, but I get your point. You're in, you made your money, you're happy.
And now we'll just watch, and there can be a correct, we could come back and correct to the top of the range again. We've seen that. One thing we talked last time, I do a lot of work with end users in terms of hedging and managing their hedge books. And so these are players that aren't trading in and out of positions. So their hedge exposure is based on what I would call, since they're net buyers, they're short the market effectively, is, sustained higher prices over a period of time. So my model and my thinking has conditioned me to go, is this a lasting rally? Is this a lasting rally over a large period of time? And I think that discipline provides a different perspective for me, because I'm not a day trader. Is I need to see evidence that this thing's got some legs or whatever, and that I can stay in this for a little while, or at least there's some ramp room or whatever. So
all right. So you wrote something. I was wading through some things that you had written, and one thing you just touched upon earlier, it prompted me to go grab that again and have you go through that again. Remember the progression: E&P first on the flat price.
Well, both E&P and refiners, right?
Okay.
This happened at the same time. You saw the refiners rally like crazy last week, right? There was,
yes. Then the merchant
Valero
refiners
was up, I think, 10% one day. So
yes.
then we'll E&P and refiners, and then like, but this is longer term, and people don't know what that timing is, and I don't know either. But I'm just guessing, because I've seen what's happened is that everyone wants that, if you want to call it beta now, that you talked about, right? Let's buy this little E&P company and it's up 20% in a day or something. Well, then that's going to be attractive. And the strip is rallying, the underlying commodities rallying, so you'll get action in.
And the dollar's still weak.
Yeah. Well, you know my view on the dollar or whatever.
I know. But for me, the dollar's still weak.
Remember the micro and macro. That's what makes you good.
But I also, I still see this growth to value rotation. And my thing was, big tech wouldn't fall apart, but it would not outperform like small caps. And so I'm still seeing this down and out sector rotation.
Totally agree.
That isn't done yet.
I'm reading this research every day, and all the resource equity fund managers are saying people aren't even allocated to energy yet, and all this repositioning.
I was going to ask you that. Yeah.
Well, great. And but that's not the world I travel in. I'll see it in open interest. I'll see it in spec interest. I'll see it in demand. I'll see all that stuff if it happens.
Okay.
Yeah.
That's all there's to say about that.
I love it.
So,
I saw someone write today, well, the integrateds won't really outperform until after 2023. Like, I don't know how you come up with that stuff, but for me, they're just a longer term survivor. The others will have challenges, because cracks won't stay wide forever. Crude could spike and cause a compression in cracks. Once the strip is done rallying or stabilizes, the production companies are basically a cost reduction and synergy play, and they're exposed to sovereigns, who have the lowest cost and will set the price. So I just like integrated because, you know, to your point earlier, you know, there's some people who think, you know, we're not going to be using oil in 15 years or something. So I
Okay.
want to own
Well,
the company that's going to be there supplying that
so there are
15%.
two other reasons I'm still bullish this sector, and I want to go over them. One is this this absolutely unmitigated search for yield.
Yeah.
And this is a fabulous fishing, in my opinion, fishing grounds here, like the Oxy with a 12% trailing dividend. That's one of the reasons why I picked that one when we were talking, because I'm like, okay, I can see that they're going for yield. This sector's obviously popping up. This one hasn't moved quite as aggressively as, you know, Exxon started the whole, was the reason for the season in many regards. But this was, for me, one really strong reason where it would start to get more sponsorship.
For sure.
The other was short covering can cause trend reversals.
Yes.
And this was the beaten down hedge fund. We're just going to short oil and gas into the ground,
Totally.
and it's never going to come back. Peak oil demand, blah, blah, blah. And now that it is hurting their, you know, the big tech isn't taking off as strongly. It has been flat basically since summer. I mean, if you look big picture on a weekly, and then you see this incredible sector rotation. They got to cover. Short covering can create trend reversals. So for me, it's still viable. I get why you got yours. You got yours.
Sure.
But I can go in.
There could be a next range. There could be a pullback. There could be any other opportunities that if my model's signaling better and scoring better, then I'll make that trade. You know, I was just telling somebody yesterday, I remember, when you're old enough, you remember these things. You're in the dot-com bubble. I got 1,000 shares of this technology company in Toronto for basically nothing. And it ended up going to $300, but I remember at $200, it was worth more than Imperial Oil, you know, which is the Canadian affiliate of Exxon. I'm going like, what am I doing? I'm going to sell this thing, right? Because this other company is real, actually makes money. So there's a lot of goofy things happening in the equity market now. So I think, there's some comfort level with buying some of these stocks, particularly the ones that are making money or got free cash flow for sure. So, but we're living in, as you know, you're trading in a different world. I don't understand it. So I stick with oil.
No, but it's great to compare, because when I look at some of the things that we've talked about in your, you know, theme and supporting evidence, and then I take a look and I look for the warning signs, for example, this inflation premium that's also helping to kind of bid up commodities, whether it be the commodity or the related companies. It is way extended now. In other words, the inflation expectation has far outpaced the actual price of crude, for example. So I'm looking at this going, all right, one of these are going to correct. The oil and gas sector for me still looks pretty good. So I'm thinking inflation expectations are going to get a little reset soon. That kind of dampens that whole, you know, parabolic rise that's going on right now.
Right. So, you know, I spent a lot of time in the spring questioning people because they're like, well, you know, oil's going to reflate, you know, and there's all that hype, but there's other commodities that are reflating because they're getting used, you know, not because there's reflation, because they're getting used, like lumber and other stuff. So again, it's going to be pretty hard for oil to inflate in any substantial way until we get, you know, at least some kind of demand recovery here, right?
Got it.
Otherwise, I don't really want to take the other side of that when that narrative gets to an extreme, right? So I try to not spend a lot of time on that, because I found, and this is why I'm really migrated to your style of trading, is that you do both, right? So I found macro tends to be late in oil, and that's something else when you think that there's a saying about oil is it never pays to be early. If you're late and you still don't get it. So I don't spend a lot of time on these correlations and that. I look at my stuff, and if oil's getting used, it's going to go up. If there's tightness in supply, it's going to go up. And if I miss a trade on someone else's correlation or graph, then that's fine.
I just think the whole theme right now that I was looking to play out was this next trend of, you know, favoring hard assets simply because they were outliers and were so extremely oversold, and the valuation on momentum and growth plays was extremely overbought. And that was my first initial, okay, I'm going to wait for the turn. But this trend in, you know, inflationary driven resource shortages like lumber, that makes perfect sense to me. And
Yeah.
but the you know, the tailwind behind oil, which didn't really make any sense to me. And I was like, yeah, I'm having a hard time getting behind it, but the center market's going higher and Robert's saying it's going higher. And I'm like, all right, I just got to trade price.
Yeah,
It ended up really coming down to that because the macro was muted.
Yeah, and at the end of the day, you know, you have to respect price, right? So, you know, I was talking to somebody about this yesterday. I mean, when whatever's happening in the market, the equity market, whatever you want to call it, if that were ever to scale back or regress substantially, then to me, you know, companies that make real money, right, become very sought after, right? So, but people have been trying to call that one for a long time. So again, we spend a lot of time betting against that. But
I do like
when Exxon gets down to multi-decade loads or whatever, and I feel like it's a good company, it's going to survive longer term, and I want to own a piece of it. So particularly if that's the only asset I trade, and I know that company, and I feel, you know, my other stuff is telling me that we're probably at a low too, then that ends up being a good trade. So
well, I like it for another reason. I like it for another reason. That narrative of, you know, folks don't expect a return of high oil is typically when it comes. And you know, right now, this inflation premium has helped bid the whole thing up, and they're definitely not prepared for inflation either. Debt is deflationary. It didn't make any sense. Why would oil be going up? But I love how we both came at it and said, "Oh my God, it's really this is viable trade here." And so
I remember the one we did, or you in for USO, and was one really didn't trade any of the big sell-off, maybe off the top, off the Iranian wars and explosions. We got that one, and we traded a little bit off of that top and kind of in the middle, but not very big. But off the bottom, there was a pop between $19 and $27, and we both got that one. I just got it as a play, and that was when USO was, you could trade it as oil. And I had some options, and you saw it in the options flow, and it was just an explosion, like a couple of days, and that was a nice trade. So your work on flows and then the macro backdrop and that is really important.
But I never.
Funny that I don't even look at that. I used to look at a lot of option stuff, and I just sort of migrated off it. But it's uncanny about when I do decide to trade, and I don't trade much, and I talk with you, you're wired the same way, so that's good.
Well, you also school me. Like I'm like, there's no way it's going to drop below 17, maximum 10. You're like, oh yes, it can. And you were spot on. I mean, it just
not the 33 negative though, or 37.
Never thought negative. Never thought even below 10. But in any case, it was a good run, and I'm still in the oil trade long. FYI.
I love it.
So until I see some of my intermarket, and I've shared that before, it has not stopped and neutralized. And that's how I basically approach the market as well as this oil trade. It's bullish, and then it's neutral, and then it's bearish. So right now it's still giving the bullish, you know, impulse, although I can see why you took Exxon off on a technical level. But I think you and I both are looking at 46. I'll hang on.
Yeah. 46, 52.
Oh yeah, or higher. So you got your calls.
Yeah.
But anything else end of year that is on your radar for risk? And let's talk about geopolitical risk. What's your biggest concern?
Yeah, I don't, you know, this is unscientific, but I just feel like it's just been quiet for too long. There's lots of things changing. We have a administration change. Sovereign economies are under a lot of pressure. It's just been too quiet for me. And so when vol was cheap, I just decided I want to own exposure to that, because you just wake up someday and something can happen, you know. And you know, people say, well, vol or geopolitical risk is low for a reason. Totally get it. Like, we're flooded with product, demand's off, but maybe it's priced low, but not for certain type of events, and really bad ones. And so I just felt like I really wanted I want to own some tail risk.
Any particular country you're worried about over others?
No, not really. Just Middle East is a goofy spot, right? So just lots of stuff can happen, wars and explosions.
Well, hey, did you see what happened to uranium complex trades and ETFs after
Yes.
that?
The Denmark release or something?
The scientist, this
Yes.
was a huge move in the uranium patch of oil and gas, sorry,
Yeah.
of companies and ETFs. So it doesn't even look done, platinum either. So how would you react to that? Would you chase it?
No,
Get something.
No, I think like I own some tail risk exposure because that's just, I think it's just, you know, it's a very small piece, but it can pay big if something stupid were to happen. So I just wanted to own part of that. And it's just been quiet for a really long time. And there's a really good reason why, you know, we haven't talked geopolitical risk for the last, you know, year. Well, we talked, you know, if you think about it, even in January, when, you know, all the stuff that happened, the attack on their Saudi oil facility and the assassination of the Iranian general, there was really not much geopolitical pop put in there, you know, so the market's become sort of conditioned to not even think about that. Before, there used to be all kinds of prognosticators, how much geopolitical geo risk is in the market, and people making guesstimates. You haven't heard that talk for a year, so I'm just thinking, well, you know, it's getting messier over there. Let's just own a piece of that in case something happens.
All right. Well, thank you for that. I'm so.
We were going to shorten that up today. That didn't happen, did it?
No, it didn't happen because I like to keep you talking. I get more and more out of it, which means everyone else gets more and more out of it. Ta-da!
Yeah, I appreciate that.
All right. Thank you, Robert, so much.
Okay.
And happy holidays, because it's, you know,
it's close for sure. 14
trading days.
We get out of quarantine here. We all get out of the bubble. You and hubby can get on your motorbikes and get up here.
Not hubby, but definitely we'll get up there. All right. Take care, Robert.
Okay. Take care.
Bye.
See you now. Bye.